We're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Avril Hong in Singapore.
And I'm David Ingles here in Hong Kong. Let's get to your top stories. Today, Asian chip makers in focus as President Trump announces a 100% tariff on semiconductors with some carve-outs for those investing in the United States.
We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge.
Now, traders are also weighing the impacts of Trump doubling tariffs on India over Russian energy imports with a warning that China could also face punishment. And momentum is building for a U.S. rate cut next month as three Fed officials have voiced concerns over the weakness in the labor market. Good morning. Welcome to the show. We're looking at market action right now. And you know what? The story is one where it doesn't seem like there's a lot of news out there. I guess, in other words, right now, we're taking this one in stride. Perhaps it could be down to the lack of details as far as, is it going to be product category specific? Is it going to be across all semiconductor products? A lot of questions remain, but how credible the threat is, we'll see what happens, of course, over the next few hours or so. At the moment, though, as you can see, equity markets are doing quite well. Half of 1% to the upside, Asia Pacific. We'll get to the earnings story because it's a big theme as well as far as Japan specifically goes today. Right, a quick glance at some of the semiconductor names. You have TSMC, you have Samsung, SK Hynix, Tokyo Electron on your screens right now. And as you can see, we're actually doing quite well to the upside. It's worth pointing out TSMC overnight did also catch a very strong bid of catch up right now. Samsung Electronics up 2.5%. We're looking at the Bloomberg Dollar Index. Reason we have that in play, it's also the Fed conversation. We have the Bank of England, by the way, on deck today. Bloomberg Dollar Index has fallen enough, and we're now again at critical support. 50-day moving average is where we are right now as far as that is concerned. Rate cuts largely expected out of the Bank of England. Apart from other things on deck today, you have a 30-year bond auction, number one, and number two is you also have some trade numbers coming through out of China, which takes us into the China part of the conversation here. And we're looking at A50 futures. As you can see here, we're flat, and Shanghai crude in focus, given, of course, all the conversations around Brent and dollar China. Nothing much to note as far as that is concerned. So it's turning out to be a big nothing burger.
Yeah, we're still watching out. Maybe this is also part of the taco trade, right? And chips, of course, given how we were waiting out for what Trump would do on these sectoral tariffs, now we know he has 100% tariffs on semiconductors in his sights. But there are carve-outs or exemptions. So we know how TSMC, given how it's committed to U.S. fab investments, that is why we're seeing TSMC surging at the start of trade. South Korean media have reported that maybe the likes of SK Hynix, Samsung, they won't be hit with these tariffs either. And then the Apple story, right? 100% tariffs for chips. Maybe it won't be part of this because of its $100 billion investment in the U.S. This is seen as a sort of win for Tim Cook and indeed Apple as well, David.
Yeah, it was an announcement before the meeting took place at the White House, and it certainly underscores, what would constitute being considered for an exemption, right? And it's really a commitment as far as, CapEx in the U.S. is concerned. And, we were looking at some statistics earlier on here, Avril. $2.5 trillion right now is that number that a lot of corporates have committed to the U.S. So we'll talk about that and, of course, whether or not that does then qualify certain things for in terms of the exemptions there, which goes into the India story, right? Because India is actually a place where Apple has actually started increasing its capacity as well. So we'll see what happens there because India is now part of the conversation. It's doubled the tariffs. And as far as the other earnings, the other theme is concerned as far as markets go, perhaps not as consequential, but it's taking place consistently under the hood. our corporate earnings, right? I think you have about 15% of the TOPIX index reporting today. We did see, of course, in the greater China space, Cathay Pacific was a big news moment yesterday, the massive drop in the stock, and I think we have a couple of big names reporting here in Hong Kong. But apart from that, of course, Avril, it's the tariff conversations, 100% tariff on chips, as you were pointing out there.
Yeah, I think that's the main bit of information we've been getting, right? So let's get more on President Trump's latest tariff bombshell, that 100% tax on chips imported into the U.S., but with exemptions for commitments to produce locally.
We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge, even though you're building and you're not producing yet in terms of the big numbers of jobs and all of the things that you're building. If you're building, there will be no charge.
Bloomberg's digital politics editor Romy Varghese and China correspondent Min Lo are with us. So Romy, let's start with you. How significant is it that Trump says he's exempting companies that build in the U.S. from the new chips tariffs?
This is an incredibly significant carve-out. I mean, if we take Trump's words, and if Trump's words are put into a plan, and we're saying that companies that have committed, promised to spend millions in the United States on factories, on production, on plants, that they would be exempt from the semiconductor tariffs. That means that the largest players in the industry won't be affected. So we're talking about TSMC, Samsung, Micron, Texas Instruments. These major players would not be affected by these tariffs. And that, of course, includes Apple. So yes, this is a huge exemption from these tariffs.
Okay, Romy, David here, let's fast forward this film. How likely is it that the iPhone will be completely assembled in the U.S.?
Well, you may remember that earlier in the year, Trump said that he told Tim Cook, I want the iPhone to be completely manufactured in the United States. That seems fairly unlikely. Even Tim Cook today, when pressed, said it will be made elsewhere for a while. Yes, so this is a significant investment by Apple, $600 billion in total in the United States, some significant investments. But no, we are not going to see made entirely in the USA a sticker slap like that on the iPhone. But Trump is satisfied.
It kind of also makes you... Romy, it also all kind of makes you wonder what this is going to mean for Apple's manufacturing in India at a time when he's doubling these tariffs on the South Asian nation. What exactly is Trump trying to achieve here?
Yeah, so as of 12:01 a.m. New York time, India will have this 25% tariff. That's the country-by-country tariffs that Trump had announced last week. Then in 21 days, if nothing changes, there'll be an additional 25%. And this is specifically because Trump wants to penalize India for buying energy from Russia. Trump is getting increasingly frustrated at the pace or the lack of progress, really, of a truce between Russia and Ukraine. And he wants to put pressure on India to stop buying energy from Russia. And, you know, we have seen this before, that Trump uses tariffs not for economic reasons, but for political reasons and for other goals. So at the end of 21 days, if nothing changes, we will see a 50% tariff on Indian goods.
Yeah, and you know what? China's now tossed into the same bucket. In the same way India was upset that they got tossed into the bucket of Russia. And Min, I'll bring you in because now this is really part of Donald Trump looping in China with the possibility that he might increase tariffs on China because of what their dependence, if you will, their buying of Russian oil.
Yes, again, this is a big question mark, right? Because the two sides just concluded their third round of trade talks in Stockholm, and there were quite positive signals from both sides. Trump even saying that he's close to a trade deal with China. But now, after imposing this 25% additional tariff on India, he's saying the same thing could happen for China. And China, of course, is the biggest buyer of Russian crude. If China were to stop buying Russian crude, it's going to be very, very disruptive and costly for the Chinese economy because about a fifth of their crude oil is coming from Russia. Russia. And this is something that China will likely push back hard against, because China already got some warning from this in the third round of trade talks. Scott Bessent mentioned this in Stockholm. China had said they are going to protect their energy sovereignty. The Chinese Foreign Ministry, in a press briefing in July, had said they would be opposed to such a long-arm jurisdiction and illicit secondary tariffs. And Global Times, the Chinese state-linked media, has also said any targeting of China because of the buying of Russian oil could potentially undermine the trade talk mechanism. So it's going to be pretty serious. If he does impose these tariffs, we could see, the progress that we have made so far really being derailed, and perhaps tension escalating once again between US and China.
And amid all this morning, we're going to be getting a snapshot of Chinese trade.
That's right. We are expecting the trade data out today, and economists are expecting exports to still hold up quite well at 5.6% versus the previous month's 5.9%. Now, we have already been getting the high-frequency data weekly, and that shows that shipments to the U.S. had started to fall after a brief rebound in June. That's after the London talks, that brief tariff pause there. So that tells us that the front-loading momentum has already started to fade. Already there's so much front-loading taking place in the first half of the year. So Bloomberg Economics believe that in the second half of the year, even with a trade truce extension, they believe that exports to the U.S. will continue to decline. But overall trade with the world, that's still holding up pretty well. It shows that Chinese exporters had been able to find alternative markets outside the U.S. Perhaps there is still some transshipments that are going on to skirt around those tariffs. And the key risk going forward is whether or not other countries start to crack down on these transshipments as part of their trade deal with the U.S. But there had been some analysts like Dan Wang from Eurasia Group who said that that risk is not high, especially among Southeast Asian countries that may not have the willingness and the incentive and the capacity to actually crack down on that. We have the import data as well coming out today. Expectations is a decline of 1%, really continuing to show that weakness in domestic demand there.
Min, thank you so much. Our team there, Min Lo and Romy Varghese there, of course, to talk us through the complications, well, the latest and the potential complications there on the tariff front there. And by the way, there's just one more ahead here on the chip tariff conversation here. So coming up here on the China Show, Reva Goujon will be joining us to talk us through the potential impact on the industry as well, what we know, what we don't know, what's actionable, and what for now remains speculation. So they'll be joining us in a couple of minutes as well, 17 minutes away, and also counting down to the open of trade. And around the open today, Haitong International Wang, Shengzu will be joining us. And on the point Min was just making, you can't front load forever. They actually think a growth surprise is in store in China towards the end of this year. The opening bell 17 minutes away here in Hong Kong, up in Shanghai, and in between in Shenzhen. This is the China Show. Good morning.
You're watching the China Show. A couple of things that we're watching out for today. After the Shanghai Comp rallied, I think, to the highest close since 2021. We also have the continued fallout from earnings, right? Cathay, those passenger yields really raised eyebrows, 10% decline yesterday. Xiaomi getting downgraded by Nomura, and then falling HIBOR, keeping an eye on trade data as well, and some of the points that our correspondents have been making. You can't front load forever. Earnings announcements as well, a number of them, including Swire Pacific. And then, of course, this also brings us to that tariff conversation, particularly when it comes to chip and Apple suppliers, David.
Yeah, a lot to watch out for that. In fact, our folks at Bloomberg Economics have really put this out, right? So obviously, I think for one, what was in terms of the sequence of events, the announcement from Apple on the commitment, $100 billion, came before that meeting at the White House. So certainly it was in there, and how they've framed it was a clear move to secure political goodwill and add resiliency to Apple's supply chain. Now, as far as what the meat on the bones is, as far as this call was concerned, $100 billion. Does not include, by the way, the $500 billion, which is separate. Establishing a U.S. silicon supply chain with partners, and as you can see, I'm not going to go through all the names on your screens right now. How do we make sense of this strategically in terms of how supply chains are going to get rejigged? Do we know enough about 100% tariffs? When, where, and what product categories? Is it a blanket across all products with semiconductors in them? Let's try and sort signal from noise. And joining us now is Reva Goujon, director at independent research firm Rhodium Group. Reva, good morning from the Asia Pacific. Thank you so much for joining us. We're all yours. Initial take based on what we've heard so far the last few hours or so.
Well, to the question you were just asking, David, on what is actually covered here, if we go back at least to the April investigation announcement, the scope is very ambitious. So it's supposed to cover chip making equipment, chip fabrication, even the actual electronic device that contains the chip. So the point here is that Trump isn't just satisfied with bringing semiconductor manufacturing to the US, right? He wants to pull the entire electronics ecosystem away from Asia to the US. Now, lots of details, right, that we need to test here on there's the tariff announcement, right, that is designed to drive these big onshoring investments like Apple just made. But what's the design and the implementation of the tariff regime is critical. So how would you design a component tariff to cover devices containing chips not made in the US? And critically, what's the phase-in timelines, right? This manufacturing isn't going to happen overnight. There's going to be consumer impacts here that have political impacts as well. And even in the most optimistic onshoring scenarios, for example, with TSMC, if they are fabbing chips for NVIDIA, Blackwell GPUs in Arizona, those chips are still going back to Taiwan for advanced packaging. So still a lot here on phase-in.
Okay, so Reva, let's play the let's fast forward that mental exercise, right? So if for example, if you were to advise the White House then how you design policy to make the threat credible, in other words, what realistically can the U.S. produce along the supply chain? How would you design that policy to incentivize capex back into the U.S. and what categories?
Yeah, so critically, it's the exemption tied to the investment project itself, right? It's not enough for this administration just to make the mega investment deal, right? So you need to ensure that these projects actually break ground. So you create an incentive by tying tariff breaks to investment projects. This administration is not a fan of grants like the CHIPS Act funding, for example. Maybe there'll be more up into tax credits as a further incentive, but that's still maybe down the line. So when we look at what tariff breaks you get, right, that are tied to investment projects, this really matters, right? Because for all these leading edge fab projects, for AI data centers, there are a lot of things that go into these projects, right? Everything from the metals, the chips, the chip making equipment. And we're already seeing some signs of pragmatism here. Take semiconductor manufacturing equipment as one example. This is where if you look at the US-EU bilateral trade deal framework that was recently announced, in the 0 for 0 tariff category, semiconductor manufacturing equipment got in there, right? So there is a reality check that seems to be dawning on the Trump administration of, look, if Trump cares about his AI legacy, his political legacy, then he's going to need to get creative in how he actually implements and applies this tariff regime while still putting out that big tariff announcement to drive these big investment project pledges.
Reva, pulling the supply chain away from Asia, investments into the U.S., this is all going to take time. It's also going to add costs. How does this affect U.S. tech competitiveness, particularly in relation to AI?
Well, exactly, right? The U.S. doesn't want to short circuit all these big AI infrastructure build outs. So it's going to need to create tariff breaks, right? These types of exemptions. It's going to need to get creative in how it implements it. That's where we'll see the details. And this may not come all in one go, right? If we take the auto tariffs as an example, that has had multiple adjustments, right, to destack tariffs down the line. This could be just as messy. We'll have to see. But I do think the president president cares about having these build-outs happen under his watch. So we will see carve-outs probably, and that's where probably the retroactive tariff threat comes into play to say, look, even if you're getting an exemption today, you won't a few years from now if we don't see these projects actually happen. But still, cost advantages is an important factor here. And as it was noted earlier, you're not going to be able to bring the entire electronic supply chain to the U.S. overnight. That's obviously going to blow commercial reason out of the water. But there is still a broader incentive to pull more semiconductor and electronics manufacturing away from Taiwan in particular. And so when we look at that, plus very high tariffs that are being imposed on Southeast Asia as well, that is likely to have some pull effect. But we really need to watch the U.S.-Taiwan bilateral closely now.
Yeah, and as you were speaking, we got this hot crossing the terminal, how Taiwan saying TSMC is exempted from the 100% U.S. chip tariffs. How do you see U.S.-Taiwan bilateral relations progressing from here on out?
Well, the Trump administration is attempting several objectives here, right? It's getting big investments out of TSMC in particular for leading edge fabrication. At the same time, it is also trying to get more out of TSMC. So we still need to see how far those pressure tactics go. It's also trying to bring more investment from companies like Foxconn. It's also trying to bring legacy chip capacity to the U.S. as well, right? So there's more to come out of the U.S.-Taiwan trade negotiation, the trade pressure that the U.S. can apply there, also security leverage that the U.S. tries to use with Taiwan. But overlaying this picture, we have the U.S. also grappling with, okay, how to get more investment out of TSMC for leading edge fabrication, but it still has an imperative to get an American chip champion to lead. And right now, Intel, which is supposed to take that mantle, is floundering. So there's more to come, I think, on the TSMC story and the Intel story as well here, as the U.S. tries to ensure that there's an American chip champion as it's drawing more of those assets out of Taiwan. But then we need to look at what's ahead out of the Trump-Xi summit. How transactional will Trump get with Beijing as Beijing tries to impose restraint on the U.S. for defense support for Taiwan? But this is the ultimate test, right, for Trump transactionalism. Can he squeeze more investment out of Taiwan, but can he at the same time probe for a grand bargain with China? That's a very tricky balancing act, but I think he's going to get further with Taiwan on this front.
Reva, pay close attention to your email because we might ask you to come on again fairly last minute. This is a developing story. Thank you so much for taking the time as my point director there at the Rhodium Group, joining us there on the chip conversation here. We just got the fix of the day coming out. It should be coming up bottom of your screen. 713.45 against the U.S. dollar, which should be the strongest going back to last year. We'll get more details on that. Plenty more ahead. This is the China Show.
Welcome back. You're watching The China Show, and we're counting down to the open of markets. All things considered, we've actually been seeing Chinese stocks faring pretty well on a 3-day winning streak. But of course, these geopolitical developments, you've got to wonder whether this casts a pall on trade today. And we haven't even gotten into the conversation about the Federal Reserve. We had at least 3 officials sounding increasingly concerned about the U.S. labor market, and that's informing bets of a dovish pivot from the U.S. Central Bank. For now, we are seeing the Hang Seng in the early goings. Looks like it could be quite a bright start. Maybe that is going to help offset some of these tariff concerns. Let's take a look at how mainland stocks are faring. Extension of the gains. Potentially, we'll see if this holds to the end of the session. A couple of sectors we're watching, including coal-related stocks. I think Morgan Stanley put out a note that they see coking coal prices stabilizing. Aside from that, take a look at how Hang Seng is faring, especially the tech names, right? Because of what we're seeing across Asia at the moment, including the likes of TSMC, SK Hynix, Samsung Electronics. It looks like a bit of a bounce on some of these Chinese consumer tech names. And of course, keeping tabs on Cathay as well, which yesterday showed a sharp decline following its earnings. Passenger yields raised a lot of concerns because it was a sharper than expected slump, but not too bad overall on the benchmarks, right? We're seeing that green still seeping through. Taking a look at Apple suppliers as well on the mainland, and it is a bright start. We're seeing it green across the board. This pledge for $100 billion investment into the U.S. would mean Apple is exempt from these 100% chip tariffs. So helpful potentially for Apple suppliers. Xiaomi as well. That's the other one that we're watching. Let's see how it is faring in trade today. This is following Nomura cutting it from buy to neutral. This is, of course, a stock that I think has tripled in the past year, and we have earnings coming out in about 2 weeks from now, down about 2.3%. But David, you were unpacking some of that earnings for us as well.
Yeah, you know what, and let me use the Xiaomi story as a jump-off point, because it's certainly, when you look at the changes that have come, I'll get to Cathay Pacific in a moment here, right? So in Xiaomi's case, it does seem that the Nomura call was more a function of how much a stock has gone up relative to us going into an earnings season, right? And that does seem to be what's consistent with the Cathay Pacific story, right? So it came out with earnings midday, one of the biggest drops on record, right? 9%, in fact, as we still speak, is still down in the early minutes right now of the Thursday session. So that's number one. And we're getting some downgrades there, and we'll unpack that in a moment and what the new price targets are. At the bottom of the screen, that's consensus rating, right? So not a lot of analysts actually cover Cathay Pacific. I'm rattling my head now, I think about less than 10. I think it's about 6 or 7. Now, what this does is it takes a score, buy, hold, and sell. It amalgamates that. 5 is the most bullish, 1 is the most bearish. We're now at 3 after those 3 downgrades, which effectively means the consensus rating on the stock is now the worst or lowest since the pandemic, when, of course, Cathay Pacific ran into all those challenges given the logistics issues right now. So, as promised, let's have a look at some of the calls here coming through HSBC, Daiwa, and JP Morgan coming up on your screens, and the new price targets there. 890, 915, 820, and we just showed you we were able trading just above 10. Stock to watch, of course, from yesterday, still is a story that will continue to track today, Avril.
Yep, and checking on Xiaomi, we're going to track that as well. As you alluded to, maybe this is also a part of how these stocks have just run up so fast. So let's bring in Wang, Shengzu, Chief Economist and Acting Head of Research at Haitong International, for a bit of analysis on the macro backdrop as well. Shengzu, great to have you with us. I mean, we are still assessing earnings, but I think the big one to watch today, aside from these geopolitical developments, would be the China trade data. I mean, what are you, kind of pulling into the equation as part of your analysis insofar?
Yeah. Okay, for China's exports in July is expected to continue to rise despite the concerns over tariff and also trade wars. Actually, if you look at the first half of year's China's exports and imports data, the imports declined slightly. I mean, the growth rate is lower than before, but also exports, again, expanded for the first half of this year. Basically, the export to the U.S., the softer growth was largely offset, or even more than offset, by export to other countries like EMEA or the Belt and Road countries. So in July, again, we expect a modest expansion of the exports, and we also expect some weakness still in the imports.
What about what has sort of helped to support Chinese markets of late? The involution rally. What sort of commitments have you been seeing from Chinese authorities so far? Does that, lift confidence enough?
Yeah. Okay. From two points of view, one on the market side, I think both China A-share and also Hong Kong markets are playing a catching up against the developed world equities, that have been lagging in the last 3 years. So this year there's a revival of sentiment, also with a lower funding cost offshore, which pushed the sentiment, also the market activities so far. But on the macro side, for the first half of the year, China was growing around 5.2% year on year, and it's above expectations. And many economists and also the market expect a softening towards the year end. The July IMF World Economic Outlook forecast revising up China's annual growth to 4.8%, but still below 5%, which means there's a softening toward the end of this year. But I want to make a point that the market may have missed, is that this is the final year of China's the 14th five-year plan. And actually, by the end of this year, there are many quantitative targets, the KPIs, need to be met. Let me name a few. For example, the total length of high-speed railway, number of airports, the number of new constructed ports, etc. Also, urbanization rate, forest coverage ratio, and also, the energy consumption per unit of GDP, etc. So, for this year, towards the last 6 months of this year, I think that the Chinese government is still going to put a lot of efforts to meeting these quantitative targets on the social and the economic development side. So this is a binding one. So that's why I see some potential upside even in the last 2 quarters of the year for the government to put more stimulus, basically to meet the target.
I'd like for you to talk a little bit more about that, because that really hasn't come up a lot. As you point out, the market might be missing that. So I think I have 2 questions on that. One is, what likely will be the boost to growth? So if we could quantify that further, the targets, because of the we're going into the end of the 14-year, 5-year plan. The second question I have is, that seems to be, correct me if I'm wrong, more on the government fiscal side. How is China going to afford that? Is there fiscal space to be able to push those projects through? And does the economy need those projects, is the other question.
Right. So maybe starting with the fiscal question.
Yes.
By end of June, if you look at China's fiscal balance, I think in terms of revenue growth and also the fiscal spendings, roughly half of the fiscal space has been spent. So it's on track. China has raised official fiscal deficit to 4% of GDP. That's roughly 5.5 to 6 trillion fiscal deficit. Okay. Year to date, by end of June, they spent around 2.5 trillion. So it's around half of space left towards the end of the year. So in terms of fiscal expansion, if they want to do more, basically to boost consumption, or like they said, to extend child care, they can do that. And also they will probably do more on the real estate side, which I see that still the largest drag factor for the Chinese economy in terms of new housing starts, transactions, etc. They can do more tax relief or certain tax exemption on these sectors. And also, as they always said, the government tried to boost consumption by increasing, for example, social security safety net to boost the confidence for consumption.
So they can afford it. So let's talk about the consumption side then. Can they afford to do everything?
No, they have to be highly selective. Well, again, it's differed by regions and the cities and in terms of social economic development. In some cities, for example, they give coupons. And in other cities, they try to boost the minimum wage or try to increase the social safety net. So they differ by cities. It's very similar to the housing market policy. Right. Yeah, each city has different policy. I think they're likely to do that, again, to boost consumption.
Now, let's talk about the housing market. So you have three components, right? One is some of the fiscal push on airports, and as you point out, the other are subsidies, childcare, for example. The housing market, to your point, seems to be losing momentum over the last few months or so. And so my question is the notion that if they fix the housing market, in a large way, they also address the consumer confidence issue. Do those two things come hand in hand, in other words?
Yes and no. I believe the government changed their mindset to downplay the real estate sector as an important growth engine.
Interesting. Okay.
The business model or the economic development model differs because China facing many structural issues. The main one is population aging, and basically decreasing housing demand.
Right.
So that's a long-term play. It's not cyclical, right? On the other hand, if China can still grow 5% in the first half of this year without the support of the housing market, or even the drag by the housing market, I think they believe they can do better, even without a huge stimulus to the housing or the property market stabilization.
Okay. Now, I want to ask about the market implication of the current state of the economy. Like the economy doesn't seem to be doing well enough to lift corporate earnings outlook. It doesn't seem to be doing bad enough that it merits a lot more stimulus. It seems to be in a gray area for the market, which is wanting either corporate earnings to come through or more stimulus. What does this mean then for the market outlook over the next, let's call it, two halves?
Yeah, I think for the next 12 months, say, as I mentioned, China is at the conjuncture of ending the existing 5-year plan.
Yes.
And also the starting of a new one.
Right.
So they're going to have a very detailed report submitted to the MPC in next March, highlighting the total achievements in this 5-year period and also outlining the roadmap for the next 5 years. So that's why the next 12 months could be very crucial. Because based on many economists' estimates to achieve the long-term goal, for example, 2035, to double the GDP or GDP per capita against 2020 level, China needs to grow around 4 to 5% on average. And China is making up some loss during, for example, the year of 2020,
right?
Because of the COVID. I think they estimate if they maintain a average growth of 4 to 5% per year, they can move towards making progress towards that goal. So that implies that the corporate earnings may not be too much upside. That's why we keep a barbell approach. For example, we overweight the tech and the consumer sectors instead of manufacturing and other traditional sectors.
Shengzu, just wondering as well, I mean, we've been seeing these tariff and geopolitical developments between the US and China. How are you perhaps assessing how this is a different episode from the first trade war and how Chinese authorities are viewing all this?
Right. I think for the US administration, their policy agenda can be described in one sentence, which is high tariff, low domestic tax, and a weak dollar. And to me, even not with China, this can imply some new, the so-called impossible trinities. Higher tariff going to push higher US domestic inflation, which make the Fed more difficult to cut. And also lower domestic tax will increase the US fiscal deficit. With the one big beautiful bill, the CBO estimates going to add to additional $3.4 trillion US dollar deficit by 2034. So it's like the current policy setup as the trade negotiation with China continue to be dismissed by the market. I think the market implications is more important, and the market may not take these sanctions or the tariff settings more permanent. they can be easily negotiated or even reversed as long as other countries promise to make more investment in the US, etc. So people are more like to watch how it's played and also how it weighs on the US domestic economy to make the administration either change their mind or the Fed to do more aggressive, more accommodative monetary easings.
What about, I mean, you talk about the U.S. economy. What are you seeing now in terms of the cracks that are starting to show? What sort of assumptions are you making about how dovish the central bank is going to be?
Right. Look at the inflation side. I think the inflation is trending down around 2.5 to between 2.5 to 3%. And also the recent labor market data, regardless the revision, the whatever, why they revise it, they showed some weakness in the labor market. The labor market is cooling down. If the Fed already did a 50% cut last September, for example, for precautionary reasons, I can see they are more likely to do so in this September, to do another cut to 25 to 50 basis points, basically according to the changing economic fundamentals.
Wang Shengzu, thank you so much for the time. We can do this again. Lots more to unpack there. Chief Economist and Acting Head of Research at Haitong International. Lots of breaking news right now. Excuse me. Get me some water, please. So a couple of things, right? So Taiwan, on the conversations around if and when, I think it's more if, we get these tariffs broadened out, Taiwan is considering to expand the special budget on chips if that is the conversation to be had. Number two is, earlier on, and as you can see the market's running with it already, 5% gains on TSMC, record high. I think this is the biggest gain in going back to May of this year. It does seem that TSMC, well, Taiwan has said actually that TSMC is exempted from the 100% U.S. chips tariffs. Okay, we will take a break. I'll get some water, and then we will regroup and figure out what we do with all this information that's coming through right now. Markets are rallying this Thursday. This is the China Show.
To some corporate headlines this morning, Bloomberg has learned that the Netflix-style streaming platform iQIYI is seeking to raise $300 million in a Hong Kong market debut this year. Sources say negotiations around the listing are fluid and the Baidu-owned company may still reconsider. If a second listing goes ahead, iQIYI will join a wave of offers that's fueled Hong Kong's revival this year. Meantime, Walt Disney shares fell after an earnings beat was overshadowed by a cautious full-year profit forecast. It now sees earnings increasing 18% in fiscal 2025, a slightly higher forecast, but short of Wall Street hopes. CEO Bob Iger says Disney will no longer report streaming subscriber numbers, calling them less meaningful. Disney also unveiled a $30 standalone ESPN app and a new bundle with Hulu. Singapore's biggest bank, DBS, reported second quarter profit that beat expectations, buoyed by a jump in income from trading and wealth fees. CEO Tan Su Shan says nimble balance sheet moves helped offset external pressure. Meantime, rival UOB reported lower second quarter profit that fell short of analyst estimates as lending income declined. Net profit dropped 6%.
We have plenty more ahead. This is Bloomberg. Right, 444. As you can see, let's call it 4.5%. TSMC to the upside. Big move up overnight, big move right now. Shares at a record high here. When you look at the news flow so far, fairly encouraging and conducive really for more gains. So number one is exemptions. Taiwan has said that TSMC is exempted to these chip tariffs that will be affecting some firms. And of course, we understand, given the news flow overnight, out of the U.S. It is 100% tariffs on chips. Now, it's still unclear, and we're still getting more information on this. Who is exempted? What product categories are exempted? There's a separate but related point on the South Korean side of the conversation, but in any case, TSMC is lifting the tide across Asian semis right now, 5% there, and as you can see, Taiwan is also getting quite substantially. One other stock that we're tracking still today is Cathay Pacific, extending the 9-10% drop that we had on Wednesday. We're still down about 3%. Brokerages have all come out, at least in the last, let's call it, since the earnings came out. At least three, I'm counting, at least three have come out and downgraded the stock to varying degrees, right? And we're looking at price targets now of $8 to $9, roughly speaking, as look at the range is concerned. Speaking of downgrades, Nomura became, I think, the latest, when I say latest, one of the rare ones in the last few months that's come out and downgraded their outlook on the stock itself. If memory serves me correctly, I think it was Morningstar back in May that did a similar move, but back to the here and now. Xiaomi cutting this one to neutral, 3.5%. That's ahead of earnings coming through, and the stock, of course, has done exceptionally well, and that might be a function of that as well. Still overwhelming buy recommendations, though, here, Avril, on the shares of Xiaomi.
Yeah, given how it's, I think, tripled in the past year, and it's been doing pretty well, right? Especially given its EV endeavors. But we are also counting down to July trade data out of China. Exports expected to hold up. 5.6% is the consensus, despite weakness potentially to the U.S. But you gotta wonder how much longer, given the front-loading effect, can this carry on? Coming up in the next hour, we'll look at the impact of the trade turmoil as well on FX markets with UBP. Welcome back. You're watching The China Show. Here's a look at the Hang Seng half hour into the session. We are seeing it slightly positive, moving off session highs, and it is kind of being supported by the mood in the rest of the region, particularly when it comes to tech, right? We're seeing the region's benchmark higher by 0.8%. And if you take a look at the broader gauges, you know, this is really being supported by the chip making related stocks. Hang Seng Tech, though, is being dragged by Xiaomi today. And I think we can show you what we're seeing in the rest of these chip related names, right? Hon Hai, Taiwan stock, higher. We're also seeing TSMC record highs. All this in relation to these tariff exemptions that TSMC or Taiwan is going to be getting from Trump, imposing potentially these 100% chip tariffs. And we're also seeing some of these carve-outs for the likes of South Korea, reportedly. Also worth noting, some of the Apple suppliers are on the move after it committed to the $100 billion investment. So bringing production back to the U.S., and that's going to help it to avert some of these tariffs. And one country that hasn't quite been able to do that, if you take a look at the India stock futures, look at how we are faring. Yesterday was tepid kind of showing when it came to Indian stocks, because it wasn't just about the tariff story. There was also the RBI's hawkish hold. Maybe it is choosing to, after a 100 basis point cut so far this year, let the cuts work their way through the system, policy transmission, right? So stocks were on the back foot. Futures now, though, in India seem to be pointing to some upside, David.
Yeah, and we'll see whether or not the cash market reflects that. All indications, though, suggest that markets will and are taking this one in stride. In fact, you know, when you look at the message that the markets are taking from the tariff conversation is how big those exemptions and holds are, really, and to the point that I think Avril was just making there, this massive move up in Taiwan. Other things on deck today, you have a Bank of England decision, which we'll get to later on. There's a 30-year bond auction in Japan, that's number 2, and at some point over the next from this point on, in fact, we will be getting the trade numbers coming through out of mainland China. We'll see what this look like within the hood, front loading, of course, and, you know, can you front load forever? is really one of the big points of conversation there. So while we wait for that, of course, let's talk about the other things taking place across these markets. So, Avril, you've talked about India. Give us more context there.
Yeah, I mean, this has been quite an interesting turn of events for the Asian economy. It was at the start of this whole trade ruction sort of front of the queue, and then in February we saw Modi at the White House. It was supposed to get some of these lower rates, all things considered, right? But then we saw in the past week getting hit by 25%, Trump now doubling it because of its Russian oil imports. So, you know, you've got to assess as well the price of Russian oil on geopolitical developments at the moment, David.
Yeah, absolutely. And I think one thing that we really haven't touched on, but is equally important, that's really the reason why India is now being part of the conversation, and China as well, and Min Min will talk more about that in a moment, is, you know, the lack of progress the White House is getting with Russia, right? And they're using, if you could call India now and maybe even China a proxy on that specific part of the conversation, that we're not getting progress, that Trump is then using this lever to maybe get something out of what he calls these purchases of Russian oil as funding the war effort, right? So it's I guess in many ways at some point things are related here as well. I haven't mentioned as well, earnings is a big theme today. We'll see what happens there. So you have Sony and the world's biggest car maker, I believe, still based on the last quarter. Toyota is reporting today, so about 15% of the TOPIX index. We'll get to that in a moment. But yes, let's get back to this. 100% taxes or tariff on chips imported into the U.S., but with some exemptions for commitments to produce locally. Have a look.
We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge, even though you're building and you're not producing yet in terms of the big numbers of jobs and all of the things that you're building. If you're building, there will be no charge.
Let's bring in our team. Jill Deeses, our news desk editor, with us here on set, and as you can see as well, Min Min Lo, our China correspondent. Jill, let's start with you. Okay, so what do we know? Who's exempt? So 100% tariffs. When does it take effect? Who's exempted? What are the loopholes?
Yeah. Well, I mean,
fill in the gaps.
Once again, David, as with Trump, it's a lot of it kind of comes down to trying to make sense of some of these comments. I mean, what he's saying there, what he just said there about building, sort of production, domestic production in the United States. I mean, if we're taking that at his word, that actually covers quite a lot of the biggest chip makers. I mean, think about. So I mean, when it comes to chip makers, there's obviously there's companies like Intel and AMD and such that design chips. A lot of these companies are often outsourcing the actual fabrication or the creation of the chip. But I mean, when you're bringing in companies like TSMC, for example, right? So Taiwanese, world's largest chip maker. I mean, they've been for the last 5 years building this, giant plants in Arizona. And I mean, if you're taking Trump at his word about this idea of, well, if you're building plants in the United States or if you're creating room for domestic production in the United States, then you're exempt from these tariffs. I mean, conceivably, TSMC or, other chip makers that ultimately, would make use of TSMC facilities and stuff would be exempt from these types of tariffs. I do think there's a lot of questions about how much production you can actually have in the United States when you're taking into account overall global demand and whether the United States actually has the capacity to do all of that. It doesn't. But I think that kind of introduces this question of, okay, well, then it kind of sounds like there's exemptions for a lot of these major chip makers, right? And then you've got Apple, which, Tim Cook appearing at the White House, kind of talking about their investment plans. It looks like they're increasing a pre-existing $500 billion investment plan by another $100 billion, talking about bringing domestic production back. I mean, it sounds to me like what Trump really wants is he wants these big flashy commitments where he gets to appear at the White House with, all of these major executives, make some of these commitments and promises. And then it does seem like you're able to kind of skate out of, some of these tariffs, at least in the interim. I don't know. Again, I think we have to see a lot of this kind of down on paper, but I think that's why you're seeing some of that good news there.
Yeah, Min Min, let's bring you in. I mean, to Jill's point, it's difficult to separate noise and signal rhetoric from actual action with Trump. He had been softening his tone towards China. Now we're hearing we could see tariffs on them for buying Russian oil, secondary sanctions as well.
Yes. Trump has definitely been dragging his feet on announcing that potential extension of the trade truce, despite, signals that that's going to happen soon. But we are days away from August 12th, and it looks like there are still a couple of things that could potentially derail that. One of it is, as he said, potentially imposing new secondary sanctions or tariffs on China for purchasing Russian oil. The 25% that have been placed on India could be a model for China as well. And this is something that will likely be very bad for trade relations, given that this is, Russia is China's largest source of crude oil, but a fifth of its crude oil comes from Russia. And we know that China has previously said it's going to oppose this, that it's going to protect its energy sovereignty, that it opposes this sort of long-arm jurisdiction. And Global Times, the Chinese state-linked media, even saying that this could undermine the trade talk mechanism. So there is this sort of oil tariff going on. And then there's another piece which is related to chips, right? The U.S. recently charging a couple of Chinese nationals for selling NVIDIA chips to China illegally. And at the same time, China expressing these concerns around security vulnerabilities of using NVIDIA chips. So it's possible that China may not see the recent reversal of chip curbs as an act of goodwill from the U.S. side. So a few things that could potentially undo all the progress that we have seen so far.
Mimi, we're expecting these Chinese trade numbers as well. How much weight is our economists putting on the data, given how, if we get the trade truce extension, that could also significantly change the picture?
Yes, we have already seen a lot of front loading in the first half of the year. And so Bloomberg economics believe even with a trade truce being extended, we are likely to continue seeing this downtrend in exports of shipments from China to the United States. Currently, we are already seeing the weekly data, the high frequency data showing that shipments have been dropping since June. But overall shipments to the rest of the world actually holding up pretty well, in fact, offsetting some of that decline in trade with the U.S. So Chinese exporters still pretty resilient here. Of course, the big question is whether or not other countries will begin to start cracking down on these transshipments going forward, especially as part of their trade deal with the United States.
Yeah, and it's a really tricky setup. How do you even quantify or define these transshipments? Great to have you both, Bloomberg News Desk Editor Jill Deesis and our China correspondent Min Lo. Now, we also had data crossing the terminal, Philippines second quarter GDP, and the estimate was for a 1.3% expansion. We're seeing it at 1.5%. This is on the quarter-on-quarter basis, so slightly better than expected. If you're looking at the exports numbers as well, they rose 4.4%. Of course, this is all coming against the backdrop of pretty tepid consumption in the Philippines. We did see that sort of play out in the inflation numbers earlier in the week as well. Still ahead on the China show, India stocks and the currency set to open in markets under pressure as President Trump doubles the country's tariff rate to 50%. A closer look at the impact next. This is Bloomberg.
Right, welcome back. India on our mind. So 25% tariffs, that's gone up by double, 50% according to the U.S. president. Over the same issue, its purchases of Russian oil. We know, of course, India's pushed back at that. It was part of the commentary coming through yesterday out of that RBI rate decision. So what we've done is we're taking a look at, number one, the economic impact, what the domestic politics will be. The other thing, too, is we've taken a massive step back and really tried and figure out really how much India is actually buying in terms of Russian oil, and really help us break down all of that for us right now. Let's bring in our team. Our oil and shipping reporter, Waylon Sun, is in Singapore for us. And on the economy side of things, Swati Pandey also joins us to talk us through the economic impact here. Waylon, let me start with you. You guys have crunched the numbers on this. What do we know? What have you found out here?
Thank you, David. And of course, we know that India is a really big buyer of Russian oil. And this really became a scenario that we've seen since the G7 put in place a price cap on the purchases of Russian oil. That was at the end of 2022, when the EU and the US were trying to force Russia to end its war on Ukraine. And up fast forward to today, in July, we have numbers showing that India is buying nearly 1.6 million barrels per day of Russian oil into its shores. And the makeup is about 37% of India's consumption of oil. And that's a very big number that we're looking at.
Okay, then what is what's the choice? What's at stake for India, number one? And I guess what's the trade-off now that India needs to consider, given first its obviously reliance on Russian crude and other things it might have to take into consideration here, Wei Lun?
Exactly. So what we have is actually a secondary tariff that might kick in later this month on top of the 25%. So what the U.S. essentially is doing is trying to influence this relationship that India has with Russia for what the U.S. thinks is helping Russia's war in Ukraine. And just to put it in context, so India exports around $88 billion worth of exports into the U.S. So that will come under a secondary tariffs. And what we have here at the same time is India's huge consumption of Russian oil. And there on the screen you can see that the state-run refineries take up almost half of it, and also the private ones like Reliance and Nayara are also big takers of Russian oil. And there we have it is that India has been relying on cheaper Russian oil that's often sold at a discount to Brent and WTI crude that's on the market. And in this case, we also can see that the Reliance, which actually has a long-term deal with one of the Russian producers, it will continue to take Russian oil. So that's a big question in place that we have in face of the secondary sanctions that the U.S. tries to place on. But taking one step back today, as we can see, India is a big taker of seaborne exports of Moscow's oil exports. So this is to say that the logistics of moving Russian oil to India can be easily shifted. It's not like a pipeline, and India can easily turn to other sources of crude. And we are coming into a season where OPEC, that means the Middle Eastern producers, are planning to ramp up production of oil. So we're going to see more and more barrels from other sources coming into the market. And at the same time, we have Russian oil, the discount to Brent narrowing. So it's less painful for India to turn to other sources of oil. But for India and what we're hearing from within the country itself, it's causing a lot of heartburn, a lot of pain for them, because they have been told, they say, by the US and by the EU that it's okay for them to buy Russian oil. I mean, last year we have Treasury officials telling New Delhi that the price cap mechanism is in place to allow Russian oil to flow and to help India take up cheaper crude. So now to have this secondary sanctions, tariffs, placed on them for buying of Russian oil, they don't really understand what's the situation over there, and they're trying to figure it out.
Yeah, well, a lot of people are. Wei Lun, Swati, on that note, let me bring you in with the economic overlay here. How has India responded now to the latest tariff announcement?
David, like William was saying, there is a bit of bitterness in the country. People are struggling to figure out why they have got the secondary sanctions when in the first place they were kind of encouraged to use Russian oil to stabilize oil prices and global supply. So far, India is standing its ground. It's continuing to buy from Russia. And it has called the move by Donald Trump as unfair, unjustified. It's also pointing to a little bit of hypocrisy by European Union and United States, both who are also buying goods from Russia. So there's definitely that question mark around why is India being targeted?
The threshold that clearly right now Donald Trump is pushing is now from 25 to 50, and is that threshold 50% rate, Swati, I guess, enough to get India to cave, I guess, in some ways?
It is quite possible, yes. 50% makes India really uncompetitive in the export market, especially with countries that India competes with. So let's say Vietnam or even China. It will impact the labor-intensive sectors really badly. So we are talking about gems and jewelry, footwear, furniture, apparel, garment. Those sectors are going to be very badly impacted. And 50% tariff will also lead to probably some demand shock, some supply shock. It's kind of unclear at this stage how big the impact will be. Some economists have earlier said 3 percentage points if it was 25%. And now nobody is willing to put a number on the actual impact that may flow through. One point that I have heard from my conversations with economists or strategists is that given that there is a 21-day timeline for the additional 25%, it looks like a negotiating tactic and not a policy. So it is possible that that 25% is removed, especially if we see some good news on Russia-Ukraine ceasefire, and then the 25% that remains will be probably negotiated, or it remains there.
And this goes into, I guess, the RBI yesterday, which I guess, to be fair to them, we didn't know, of course, we were going to be facing a double tariff today, but, you know, they did leave their policy rates unchanged. Is that in some way keeping their powder dry in case things then worsen? Swati?
Yeah, so the RBI also published forecasts for inflation and economic growth, and they left their GDP forecast at 6.5% unchanged. And that was largely because of these uncertainties. 25% was known. It was known that there will be additional tariff on like a punishment for buying Russian oil. How much extra was not known. And in spite of that knowledge, they left the economic forecast unchanged at 6.5%. The RBI did signal that room for further easing is limited, which means the bar is quite high. So the economy has to go through some real pain for the RBI to come in and ease policy further. Probably they will rely more on fiscal stimulus or other measures that the government can take to promote some of these labor-intensive industries that would be heavily impacted from these tariffs.
Fantastic, team. Thank you so much for the time today. Swati Pandey there on the economy and, of course, the oil angle, which is really at the center of this right now. Williamson in Singapore for us there. On the currency, just very quickly here. So we're obviously looking at this. It's been under pressure. That's not a big surprise. The level you want to track is the high that we hit back in early Feb 10, and that level is 87.9563. If we get above that, of course, that takes us into new territory. We did get a note coming through yesterday out of MUFG, I believe, is that at 88 is the level that the RBI might come in and intervene. Right, and we'll have more on this. In fact, I'm very excited for this one. Bottom of your screens, that are times on your screens. A live Q&A, really, on India. That starts 8:30 p.m. if you're watching, or if you are based in Hong Kong, 1:30 p.m. London, if you're in the U.S., that's 8:30 a.m. Your time, details there on your screens, what it really means as far as the broader conversation goes between the two. Plenty more ahead. This is The China Show. Welcome back. In some corporate news we're tracking this morning, earnings is a key theme. Walt Disney will start there. Shares down overnight after an earnings beat was overshadowed by a cautious full-year profit forecast. It now sees earnings increasing 18% in fiscal 2025, slightly higher but short of Wall Street hopes. CEO Bob Iger says Disney will no longer report streaming subscriber numbers, calling them less meaningful. Disney also unveiled a $30 standalone ESPN app and a new bundle with Hulu.
We are building on Disney's value proposition in streaming by combining Hulu into Disney Plus to create a unified app experience featuring branded and general entertainment, news, and sports, resulting in a one-of-a-kind entertainment destination for subscribers.
McDonald's says sales picked up in the most recent quarter, suggesting that the recent pop culture-focused collaborations and budget meals are, well, paying off. And the global sales at restaurants operating at least 13 months, same-store sales effectively here, up 3.8%, beating Wall Street estimates. But the company says it's seeing weakness in its breakfast menu, which it describes as economically sensitive. Now, Singapore's biggest bank, DBS, reporting second quarter profit, beating expectations, really lifted by a jump in income from trading and also wealth fees. The CEO, Tan Su Shan, says nimble balance sheet moves helped offset external pressure. Meanwhile, you have UOB also coming out, reporting second quarter lower 2Q profits here, short of estimates as lending income declined. Net profit dropped about 6%. Right, staying on the, well, loosely on the earnings theme because Xiaomi's reporting in a couple of weeks. Interesting, though, is we talked about this first call coming out of Nomura, cutting the spoon to neutral. First downgrade in several months, but after that, though, we've seen a series of brokers have come out and said the opposite, right? Still bullish on the stock. Reason this is important is the stock's actually down quite substantially today, similar to the BYD conversation we had yesterday. Charts coming up for the first time going back to early April, let's call it late March. We're not trading below the 100-day moving average, 51 right now in Xiaomi. Plenty more ahead. This is the China Show. Right, welcome back. Going into the Japanese lunch break, we are in the thick of earnings season there. In a couple of, in fact, I think at some point in the next 2 hours, Sony, I think, is coming out. And of course, towards the latter part of the day, the likes of Toyota are coming out. We'll show you really how much this is an earnings theme today. All that said, the market story is, well, news on tariffs, some really not as new. Markets are running with it so far, taking it in stride, and it seems the markets are focused specifically when you look at Japan, Korea, and Taiwan. Tech, AI, chip-heavy benchmarks are focusing on the good things, right? So exemptions, what have you. As you can see, 1% to the upside. In a couple of minutes, we'll be getting the 30-year bond auction over Japan results there. Demand, everything else, right? Tail yield, bid to cover, what have you. On your screens right now is the curve from 10s all the way down to the 40-year yield. So as you can see, we're down on the 10. So we are steeper going into that auction today. A couple of movers to tell you about, reported as of the close yesterday. So initial reaction is coming in today. And as you can see, quite substantial reaction on some of these big names. About 120-ish companies reported yesterday on the TOPIX index. You add that to about a 250 that reports today, and you get a 24-hour window where effectively you have about a fifth of the TOPIX index in terms of the number, right? Not market cap, not value. About a fifth of index constituency. There we go. That's the proper term. That are reporting earnings as well, with global implications, of course, given, of course, how some of the big names are coming through as well. In fact, on that very note, 15% is the 251 reporting on Thursday, and some big names on your screens. And there's a separate conversation on, I think there's a story out on tariffs affecting the prices of consoles, right? So Sony's going to be part of that, SoftBank Group, and of course Toyota, which I think makes cars. We're not sure. Okay, later on we'll be speaking with NTT Data Global Chief Growth Officer in North America, CEO, and that's after the company reported an operating income that missed for the first quarter. Exclusive conversation coming up on Insights, which has in the next hour. Okay, let's talk about politics, shall we? You have top trade negotiator Ryosei Akazawa has met with U.S. Commerce Secretary Howard Lutnick, urging swift implementation of their deal to reduce tariffs on cars and also auto parts. That comes after Prime Minister Shigeru Ishiba admitting getting a win-win outcome will be a challenge. For more on this, let's bring in our Japan politics and economics reporter Sakura Murakami, joining us from Tokyo right now. Sakura, thank you for joining us. Well, what has so far come out from that visit? What were the wins that we can count so far, if any?
Well, I'm not so sure about the wins just yet, actually. So far, what we do know is that Akazawa met with Lutnick, as you said, and he's urged Lutnick to implement the tariffs, implement the agreement that the US and Japan have agreed on so far. What's coming to light is that there are slight discrepancies in the understanding of the trade deal, and that includes one element, which is whether the tariffs that have been announced, the 15% tariffs, are actually stacked on top of existing tariffs or not. And this has become a bit of a point of concern in Japan, because there have been reports that US officials are saying that they will be stacked, whereas Ryosei Akazawa and Ishiba himself has said that they won't be. So this is a bit of a point of divergence that we'll be keeping our eye on.
Oh, that's a very diplomatic way of putting it, a point of divergence. Okay, well, speaking of, let's underscore that point even further. What other areas are the U.S. and Japan still at odds with each other when it comes to the agreement?
So, yeah, beyond the whole whether the tariffs are stacked or not, there's also the question of for example, the $550 billion investment plan that President Trump has touted as almost like a signing fee for a baseball player for him. He said that the U.S. has complete control over how to spend this money, but that's not really the rhetoric that's coming out of Japan. Japan is saying 1 to 2% of that money will be actual investments, whereas the remaining will probably be a mix of loans and grants. And ultimately, these investments and these loans and grants have to be beneficial for Japanese companies. It will be at the behest of Japanese companies. So there's a point of difference there as well, you could say. Also, when the auto tariffs will be implemented is also a very big point of concern for Japan. Currently, the auto tariffs are 27.5%. So far, we've heard that the agreement is to lower this to 15%, but there's not been any clarity on when it actually will be implemented. So that's something that Ryosei Akazawa will be probably pressing his U.S. counterparts on while he's in D.C.
And how much time might this buy Ishiba in terms of being able to sell this domestically and his longevity, of course, as Prime Minister then?
Well, it'll depend on how how well Akazawa's visit in D.C. goes. At the moment, Ishiba is facing a plenary meeting tomorrow within the LDP. He'll be trying to convince his peers, the people in his party, that he has a mandate to stay on because he has to see the U.S. trade deal implemented. He has to see it through. But there are voices in the LDP calling for him to step down. That being said, the broader public doesn't necessarily see Ishiba as the problem. They also see the LDP as the problem as well. So how long he stays on is still a bit up in the air. Some people say, maybe the end of August, but we'll see how the visit, Akazawa's visit in D.C. plays out, and also how the plenary meeting tomorrow plays out as well.
Okay, stuff to watch. Sakura, thank you so much. Sakura Murakami there in Tokyo for us. We're just going into about 5 minutes into the Tokyo lunch break. We went into the lunch break on fairly decent footing as far as that's concerned. Slight declines, as you can see, about an hour into the cash market session here in Hong Kong and up in mainland China.
The labor market has softened, and you can see this everywhere in the U.S. economy and here as well. And I would see additional slowing in the labor market as an unwelcome sign. So all this means, as you put it together, that I think we'll likely need to adjust the policy rate sometime in the coming months.
There were major revisions, so two major revisions to May and June. And these revisions are somewhat typical of turning points, which again speak to uncertainty. And Susan is absolutely right. We want to know not just where we've been, but where we're going. So if we're at an inflection point, we want to look at data, for example, that speak to inflection points. And it's not always payrolls. The unemployment rate is still a good indicator of slack in the system, but we have to look at the panoply of them, and we have to keep a close eye on these.
In case you haven't noticed, the tone's changed, right? And, you know, we're coming off Mary Daly and, of course, Lisa Cook, separate events on the weak U.S. labor markets data. And then, of course, not to mention the ISM, of course, this week, the services number. Now, you have Neil Kashkari here on your screens. Effectively, what he's saying is it might actually be time to adjust interest rates. Traders have priced in certainly as much ahead of the FMOC's September meeting. So just some dates to watch, right? September, and this is if you're in Asia, right? September 17, that's the next meeting. After that, it's well, not that it's related to, it's 2 days before Halloween, October 29. And then the last meeting of the year is December the 10th. And then next year is January 28th. And you look at the reason I bring up 4 meetings is because currently the pricing is 3 cuts over the next 4. So 1 is a skip, but that's a moving target altogether. Markets seem to be coalescing around a September cut now as base case, and I guess we can worry about other things after that. Let's bring in the Asia head of FX sales and execution at UBP, Ignatius Pong, who might be able to help us understand this even further. Nice to see you. Good morning.
Thank you very much, David.
So 4 dates I mentioned there, September, yes. October, December, and January.
Yep.
When do you think the first one's going to be?
Well, I think we will get a clearer indication as to when the next Fed rate cut will probably be in this incoming Jackson Hole Symposium, which is expected to be between the 21st to the 23rd of August. So, and the Fed has typically been always erring on the side of caution. So I think they are very data dependent as well. So of course the last labor market reading was definitely disastrous in a sense, and with the revisions in the previous few months as well, the market is starting to anticipate that September is a very live meeting as well. But however, we still have 2 more CPI readings into the next meeting. That will also probably be very much watched by the market. And like you had mentioned clearly, it's a moving target, and it will be very much data dependent. But our base case is that we are probably expecting 2 rate cuts this year, but the first one probably, the last one will be in December, and the second one, the first one in October, and the second in December as well.
Okay, so we're down to 100 basis, 50 basis points. I'm sorry, 50. Not 2 big ones.
Well,
okay.
2 big ones we have a problem.
We don't want to be in a world where we're getting 2 big ones consecutively. Okay, at what point does the dollar start to move then on interest rate differentials? Or is that, in other words, what has been the biggest move, driver of the U.S. dollar? Sentiment, flows, positioning, or is it rate differentials at some point?
It's a combination of all, actually, at this moment. Positioning, like you said, and after the sell-down we have seen in the U.S. dollar since Liberation Day itself, we have seen a period of consolidation in the U.S. dollar. And to this current juncture, I think the interest rate profile of the U.S. dollar is starting to take the forefront in driving FX markets as well. Positioning-wise, the market is starting to consolidate on that front. Okay. And if we were to recall back the previous week, when the dollar gained 2.2% in just a matter of 1 week itself, its fastest gain in 2022, this was a clear indication that the market was highly consensual in selling the dollar, but with not a very strong conviction. And the rebounds in the dollar are possible as well. So we are actually looking at these opportunities to actually diversify out of the U.S. dollar, doing sporadic bounces in the U.S. dollar itself.
Okay. Yeah. So that bounce effectively, you think, was just simply extreme repositioning?
It's a consolidation after extreme positioning, like you said. Okay. And also as the market tries to juggle between the interest rate path of the U.S. of the Fed themselves as well. Right. This is also another determinant for the U.S. dollar in the short term. Yeah.
Now, do you see any? Before we get into the sort of idiosyncratic stories on, I think you have the Bank of England, you have what's happening in Switzerland, and them leaving without a win. India. I want to get a sense of when you look on the horizon, is there a catalyst that you see, even if it's a tail risk, that catalyzes the sustained rebound in the U.S. dollar?
Well, a sustained rebound in the U.S. dollar would be a refulfillment of the confidence in the U.S. dollar after it was lost in April itself. So that would mean, number one, very healthy fiscal balance in the U.S. side of the economy, and then the Fed actually communicates effectively the number of rate cuts that they are going to undertake, not only to the end of 2025, but also in the 2026. Now, that's the problem. In 2026, we actually have Jay Powell potentially stepping down as well and being replaced there. So the market will be probably pricing very aggressively the number of rate cuts in 2026, and that will be a driver for the dollar itself. Yep. And as we go on into all the trade negotiations that the U.S. is starting to ink in its favor, that actually has put the trade policy part of the U.S. Dollar equation at the side at the moment, with the market refocusing back on interest rate differentials again.
Or the lack of deals that have been inked. And I think the reason I bring that up is Switzerland, for example, dollar Swissy.
Dollar Swiss.
Yeah, where do you see that going? They seem to have left without anything.
Yes, that's right. And I think as we speak, she's on the way back to Switzerland as well without inking a deal. Now, the 39% tariff is in place at the moment. Of course, there's a lot of analysis as to why the current home surplus is huge in Switzerland, being blamed on their exportation of gold as well. Now, in terms of dollar Swiss, I would say that we will probably see a consolidation in dollar Swiss above 80 cents. With a risk of it grinding up towards 82 in the short term. Of course, the Swiss National Bank itself will probably want to keep the Swiss on a looser footing, or on the weaker side, especially especially in the absence of any trade agreement with the US at the moment. Yeah.
What about cable?
Cable.
Yeah.
Very exciting day today. We have the Bank of England meeting.
Yep. It's a cut, right?
It's a cut. 25 basis points fully priced in.
Okay.
So I guess, and again, the rhetoric will be clearly watched into as to how many rate cuts they'll be pricing in for the rest of the year. So far, I think the market's pricing in 2 rate cuts. But of course, that will be very dependent on the data side as well. I mean, the UK has been facing a weak labour market. And also to the same extent, they have a huge funding gap as well, which they are trying to restore confidence in after what we had seen a few years back as well. So the rate cut is definitely priced in at 25 basis points tonight. But I would probably have to examine clearly as to what the rhetoric is coming, the rhetoric from the Bank of England themselves, before actually pricing the next rate cut from them as well.
Is the Bank of England a bigger driver for cable, or is it these fiscal concerns and the funding gap that's seem to be every now and then seems to be moving the needle on this?
Exactly, and that is also one of the reasons we had seen cable actually collapse to around 132 recently as well. Combination of factors, the weak labour market on that front, and also the funding gap that the UK is facing has basically kept the risk very much idiosyncratic on the side of the cable. So if any rebound in the cable, you would definitely be on the back of the US dollar itself, and not because of any cable-specific factors. Yeah.
Okay, I think final question for you. India's a big story today.
Yes.
We're looking at a the Feb 10 high of 87 and change, I think, was the record low. And there was a comment yesterday coming through, I think, out of MUFJ, that 88 is the level at which they might come in and defend it.
Yes.
What are your expectations in terms of, short-term moves in dollar India? And what is the level that you think authorities will come in to intervene?
Well, that's a little bit of a target, almost akin to HKMA itself. And,
is it? Okay.
Well, in the sense that 88 is a round figure, and that was exactly near the high that we had seen in the dollar INR just a few weeks ago as well. Now, if we look back at what the RBI had mentioned yesterday as well, it was clearly a case whereby they were focused more on currency stability rather than growth risk as well. And of course, with the 50% tariff that was put on them last night, there is a risk that we might see dollar INR break above 88. But we do not think that will be a very sustained move higher, because we will probably see a renegotiation going on again, and that will probably see a restore in confidence and prevention of capital outflows out of India.
Fantastic. Thank you so much. Nice to see you.
Thank you very much, David.
Let us know next time you're back in town.
I will.
Right, there we go. Ignatius Pang, Asia Head of FX Sales and Execution at UBP. Okay, lots more to talk about. A couple of big movers on your screens. There's a quick glance at the FX complex right now. There's some big stock movers here in the Asia Pacific, including Hong Kong. You have Xiaomi, you have Cathay Pacific, which I guess we can cross that bridge in a couple of minutes. We're back from a break. Plenty more ahead. This is The China Show. Welcome back. Chips is a big story today, and as you can see, TSMC up by 5% is really all this benchmark needs with the weighting that one has really on the benchmark. Record highs there on TSMC. It goes into the AMD part of the conversation, chip tariffs, what have you. So you have shares of AMD gaining in after-hours trading in New York. Again, similar theme here, investors reacting to President Trump's plan for 100% tariffs on chip imports. Now, earlier on, its earnings report also offered little clarity on when AMD might actually resume its sales of key chips, AI chips specifically, to the Chinese markets. CEO Lisa Su told Bloomberg that she is optimistic about progress towards a resolution.
I know people always want precision, and what I will give you is exactly how things are playing out from our standpoint. I think we've seen an improvement over the last 90 days. 90 days ago, we did not expect to be able to ship to China because of some of the regulations. I think this administration, the Department of Commerce, the government has actually been very open to trying to find the right balance between national security and ensuring that we have U.S. AI technologies proliferated across the world. So we think that's a great balance. We now know that we have a number of licenses that are under review. We've been given good indications that those are moving through the review process. And we will certainly inform everyone when the licenses are granted. But given that it's hard to predict exact timing, just given all of the things that are in front of the government at the moment, we thought the right thing to do right now is just say, hey, let's not include that in the third quarter revenue. But even with that, we're growing 28% year over year, which is, fantastic growth rate. And if you asked me, what we've learned in the last 90 days, we've learned that the demand is even stronger in the second half of the year than we necessarily, thought maybe just a few months ago.
And analysts really corroborated and thought it was right that we should see such caution perhaps and not show up in the numbers. But Lisa, I'm interested in the inventory that you had been very clear about, the $800 million knock on the fact that you couldn't access China for a while. I know that most of those manufacturing hadn't been complete, but do you think you can unwind that $800 million? How much do you think can you bring that back to bear?
Well, we certainly expect that once licenses are approved, that we will, restart our supply chain and, get those in place. We do have, a bit of time that it takes to complete those, but we would expect to be able, to ship some of those products as licenses are approved. And, again, the exact timing will depend on when licenses are approved. But I, again, would hope that we don't get caught up in, something that I would say is moving actually in the right direction, and really see like the overall business is doing extremely well.
There we go. That was the boss at AMD, Lisa Su, with Caroline Hyde, of course, our colleague there, post-earnings, and really as much clarity and context and granularity that's possible without going into speculation, of course, post what they can do as far as the Chinese market is concerned. Okay, that was just me buying 15 seconds of the time. Okay, pounds and some of the crosses here. You have cable and everything in between. Bank of England rate decision in a couple of hours or so. It's a consensus, really. Every single economist that we've surveyed expects a cut to about 4%, I believe, as we are on that. We did get a bounce off from the 132 handle on that. We're back above a key moving average on cable. This note just dropped in our inboxes right now. This is on several markets along the tariff conversation. So UBS has overweight on China, Brazil, not on your screens, Indonesia, Malaysia, and the Philippines, because these markets are largely indifferent, according to UBS, to tariff risks. We are more worried, they say. We stick with tariffs as an important market selection theme for now. So among EMs, these are, including Brazil, are the top picks out of UBS. Nifty futures on your screens. India, quite literally 50 is the number of the day, from 25 to 50 as far as the tariff goes there. We'll see what the impact's going to be as far as the market goes. All indications are, though, markets will be ignoring this. Cash markets are set to open higher. We're coming off 24 hours from the RBI. The other thing, though, is what the currency is going to do, right? Because we're trading at about 87 and change. 87 on the higher end of that takes us back to Feb 10 levels, which is the level to watch. So stay tuned for that. One stock we're tracking still today is Cathay Pacific, extending the 9-10% drop yesterday, which really puts the stock on track for one of its worst weeks ever as a public company post-earnings. A couple of brokerages have downgraded the stock. We're down about 3% going into the last 60 minutes of trade, where we might actually get, and probably will get, the trade numbers coming out of China. July numbers preview on your screens. And yeah, we are expecting a contraction there in imports of about 1%. All things equal, trade balance, $105 billion US dollars. That's it from us here on The China Show. We'll see you all tomorrow. Chinese markets go on break in 20 minutes. Stay tuned, though, for more here on Bloomberg Television.